Hi, everyone. Good afternoon. My name is Joseluiz Morales. Welcome back to the Joseluiz Morales Show. Today, we've got a very special guest, Mr. Carlos Camargo himself, the reverse mortgage specialist here in Southern California. So today, what I wanted to do is I wanted to educate the community on what is a reverse mortgage, who can take advantage of a reverse mortgage, and when is a reverse mortgage most appropriate versus not. So welcome to the show, Carlos. How are you doing today?
I'm doing great, Jose. Thanks.
You're very welcome. My pleasure. So yeah, great. So if it's okay with everybody, let's start off with what is a reverse mortgage. And I would like to welcome everybody. If anybody has any questions throughout the show, just ask them and we'd be happy to answer them for you guys. I'm going to have my Facebook page open. So if anybody has any questions in regards to what is a reverse mortgage or how it can benefit you, feel happy to answer. So let's start off there, Carlos. What is a reverse mortgage?
A reverse mortgage is just a special loan instead of qualifying like traditional loans where we look at debt to income ratios, loan to value ratios, and credit history. It's for people that are 62 years of age or older. They use the house as the collateral and no monthly mortgage payments are required. They can make payments if they want to, but it really frees up cash flow when they don't have to make a monthly mortgage payment.
Okay. So like, let's say somebody is older than 62 years old and maybe they've got a mortgage payment of about $1,000. And because they're on a fixed income, maybe that's a little bit excessive for them. Maybe they're barely making ends eat. How can someone like that, how can it benefit someone in that situation?
Traditionally, the reverse mortgage had been used as a refinance transaction, exactly what you're talking about. It's been around since 1961. It didn't become a federally insured government loan until Reagan's administration in 87, and it was in 1988. So 30 years ago, we just did 1 million reverse mortgages, just hit the 1 million mark. But the reverse mortgage is going to free up that cash flow. The scenario described, a fixed income senior, their household expense, for that matter, everybody, the household expense is their largest expense on their budget on a month-to-month basis. So not having to make a monthly mortgage payment, that's going to free up that other money that they do receive, and now they can use it like anything else for discretionary purposes.
That's wonderful. Okay. And you mentioned that it's typically used as a refinance. I know that recently we used it for a purchase as well too. How does that process work, and how can somebody who does that benefit?
Yeah, this is the part that I'm most excited about working with my real estate partners like yourself. It's been available since 2009, where someone 62 and older can be able to get into a more desirable property, possibly to age in place. They might be moving closer to family or friends. The transaction that we had with your team, she was looking to relocate from Los Angeles County in the Toluca Lake area, Burbank, out here to Ventura, possibly Ojai. And just yesterday, I was in another San Fernando Valley meeting where they wanted to relocate out here. And they're in a 2-story house. As people age, that's a dangerous situation. So sometimes it might be to move closer to family or friends. Sometimes it's to get out of the San Fernando Valley in LA County and come out here to Ventura County. And the reverse purchase allows someone to be able to buy a property with the reverse mortgage and have no monthly mortgage payment. So the scenario that I was running just last night was the property value is about $780,000. They have a mortgage where they're making a monthly payment, a couple $100,000. I think it's about 265, 270,000 is what they currently owe. They'll be able to sell their house and be able to move out here to Ventura County. They're going to buy a property at $675,000 here in Ventura, and now they'll have no monthly mortgage payment. They're going to use about $300,000 of their equity from selling their house in the valley to move out here. That's their equity position that they're going to have in the property. So they'll have no monthly mortgage payment, and now they're going to probably put about $133,000 in their bank. So they're going to be able to move out of the valley, come out to Ventura, get a house for $675,000, and because their property is $770 to $780, they're going to be able to transfer their tax basis as well. So the real estate Prop 90 will allow the reciprocating county of LA to Ventura County. So they've lived in their property almost 40 years. They only pay $2,000 a year in taxes, whereas on a 675 purchase, new tax basis, that'd be about $15,000. So they're going to be able to save on their tax basis, be able to have no monthly mortgage payments, and be in the area that they want to retire in.
That's wonderful. And for somebody like that, I hear an echo. You had the Facebook Live as well too? Or?
I'm good. It did echo a little bit, but you're back to normal.
Hello. Yeah. Okay. Great. Perfect. So, what I was going to ask you, for somebody like that, do they have to be 62 years of age on the purchase side, or is that just on the refinance side?
So on the government-insured reverse mortgage, it's called a HECM, a home equity conversion mortgage, because that's what they're really doing, is looking at a home equity position. The government wants someone to be 62 years of age. They used to require both, but now it just requires one of the two homeowners, if it's a married spouse. There is going to be a new reverse mortgage. It's not a government-insured. It's a proprietary. Probably released this coming month in July, and they're going to drop the age down to 60. But most of the reverse mortgage programs are all 62 and up. Yep. Well, there's even the ones that are not the government insured. There's a proprietary reverse mortgage for jumbo transactions. You can go all the way to $4 million with the jumbo reverse. And it models the reverse. That's the government one that you're supposed to be 62 and older.
Yeah, that's great. Now, how does that work? Because I know a lot of times where people are downsizing, maybe either they're A, retired, or B, maybe they don't make as much money as they were when they were working full time. For that example that you gave us, where they were selling at about 780 and they were purchasing in Ventura County, do they use a lot of the equity to help them qualify for the new property, or do they still have to have some sort of income? Even though they're not going to have a monthly payment? How does that aspect in terms of the qualifications work?
Yeah, Jose Luis, the government wants the person to make sure that they have some income, right? Because you're still going to have housing expenses for utilities, food, etc. So in the Western United States, the government says you should have just under $1,000 if you're a married couple of residual income after your normal bills are paid. So they do look at it. If it's a single person household, it's only $600 that they need. And although it's not common, we do have an escrow impound account for those fixed income retirees that want to have taxes and insurance paid as well.
That's great. And when you say that there's that there's an escrow account, does that mean that they would just make a monthly payment for that? Or does that mean that would be taken out from like on a month basis? It would just accrue additionally based on the equity of the property?
Right. The second part of the question, they don't normally, like a normal loan, you're just going to make that extra escrow impound account on a month-to-month basis. But with the reverse mortgage, since payments aren't required, then they set aside a certain portion of the amount of money that you can have, or on a purchase, they would ask you to bring in more money so that you can have the money set aside in the servicing for the payment of taxes twice a year for property taxes, and then the homeowner's insurance. So no, they're going to dedicate a portion of the proceeds for impound accounts, and then they'll manage that for the senior.
That's perfect. And for those people that don't understand, I mean, they're probably thinking like, oh my God, so I'm that age, 62 years of age, and I'm not going to have a monthly payment. Who's going to pay for the monthly payment? So how does that aspect of it work? Just for the people that don't really have a background on it, to simplify it.
Yeah, Jose Luis, this is probably the most confusing part, because since 1961 to 1987, there was a lot of stuff that happened. The reverse mortgage is going to be paid back in the future when one of three things happens. When they sell the house, everybody gets that. It's like a normal loan. It has to be paid back. This is owner occupied. So the second one is when they're no longer living in the property for 12 months or longer, they consider that a permanent change. They don't want renters being in the property. So that would be a callable feature. And then death is the last time that the family will now have up to 12 months to decide if they want to keep or sell the house. But the interest is just being deferred on top of the loan. So on a monthly statement, they're still going to see what's happening each and every month, how much interest is accruing. And if they want to make payments, again, they can. But most people like the cash flow benefits of not having to make that payment anymore.
So essentially, if I'm understanding correctly, or at least the way that I understand it is, let's say that the principal that the loan amount that they owe is $200,000, and since they don't have to make a monthly payment on it, every month that principal amount would essentially be going up by the amount that they would normally be paying, essentially, right? Okay,
that's exactly right. So if the loan has an interest rate of 4% on 200,000, like you said, that would be an $800 amount that's interest that's going to be compounding. And so if they're not making a payment, then their balance will be going up that first month by $800 on the interest side. That's right.
And then at any point, like what I'm understanding from the program, it doesn't like tie them up into anything. Essentially, if they get a reverse mortgage a year from today, they owe $200,000. Their balance is increasing by whatever it is, $800, $1,000, whatever it is. At a year from now, they could still essentially sell the property, and then the payoff amount would just be based on how much interest has been accruing, right?
That's exactly right. This is where a lot of misinformation is, and a lot of families and people, if you just ask in general about the program, it still has a negative connotation. But when people actually understand how it works very similar to a traditional loan, but it gives the flexibility of the monthly payments not having to be made. If no payments are made, yes, the interest is going to be adding on. The homeowner or their family is just responsible for how much money was borrowed and the interest that accumulates monthly on that. There's also built-in mortgage insurance that protects the family in case the banks ever fail, like they did with Washington Mutual, Wachovia, Countrywide back a couple of years ago. And it also protects if we have a correction in the market, similar to what happened 2007 to 2011, where people owed more money than the house is worth. This is the only residential real estate loan where it's non-recourse, meaning they're not on the hook, nor are their family members on the hook. The mortgage insurance will pay back the lender any shortfall amount when they go to sell the property or when they pass away.
Yeah. Well, not only that, like I've ran into situations recently where somebody has a reverse mortgage. They got it a long time ago. They didn't have to make any payments for 30, 40 years. And then they end up, the loan balance is higher than what the market value is worth. And in that case, the family doesn't have to do anything with it. And it doesn't really affect anybody. But for somebody on a fixed income, somebody that only has Social Security or a certain amount on a monthly basis, and they're worried about having to make a monthly payment, essentially it's a great option because they can use a lot of the fixed income for food or some of the daily living essentials and take advantage of a lot of the equity that they've accumulated in the property. So essentially, if the loan balance is more than what the property is worth, at the end of the day, essentially it just goes back to the bank, right?
Officially, they're going to ask the family still what they want to do with the property, because the family can be able to keep the property and pay back 95% of fair market value. They don't have to pay back what's owed. So it doesn't automatically transfer over to the bank, but it would be listed with, like your group. And then if there's any shortfall, the mortgage insurance pays back the lender the difference. The family's able to walk away free and clear, similar to like a deed in lieu transaction that you would have had with a regular finance. But your fixed income retiree, we just had a loan there in Camarillo where the 96-year-old widow, she'd been widowed for 20 plus years, had run out of money, but she had about $5,000 shortfall each and every month for long-term care expenses. She's got caretakers now coming in a couple of hours a day, 7 days a week. And so she needed some extra money. She's got a property, $650,000 in Camarillo. She was able to tap into $480,000, and she's going to take $5,000 a month. So, her fixed income portion wasn't able to cover it. and now she can use the money for anything. And again, it's tax-free proceeds. It's considered a home equity loan. She could not qualify for a traditional home equity loan or a traditional mortgage, where here we were able to give her up to $480,000.
Let me ask you a question. So I know that you can defer the interest, or basically not have any monthly payments. In the situation that you described, does that mean that she's getting monthly income from it?
Yeah.
Really?
For her, and technically it's not considered income because it's a home equity loan. It won't count against her taxes.
So it won't affect her taxes?
It does not jeopardize taxes, Social Security, or Medicare. And depending on some of those need-based homeowners in the community that qualify for Medi-Cal, they can even pull money to be able to pay for their daily expenses, as long as they don't cap out and exceed $2,000 a month or whatever that threshold is. They don't jeopardize those benefits as well. But for her, she's going to be receiving $5,000 a month to help pay for her caretakers. And she's going to have a line of credit for about $180,000 for unexpected, costs that may come up in the future that are ad hoc. So if her car breaks down, she needs work done at the house for deferred maintenance, she's now got a bucket of income that she can be able to tap into.
That's great. And the cool thing about a reverse mortgage as well, too, like it doesn't, like when you enter into the reverse mortgage agreement, like it doesn't matter if the property, if you outlive the equity in your home, like for example, like if the 200,000 example, and then it gets to the point where the home is worth 500,000, but if you outlive the point where it gets to 500,000, they don't make you start making payments, right? You just continue living there until one of those three things happens that you described, correct?
That's correct. This is one of the fundamental differences between a reverse mortgage and traditional financing. A typical 30-year fix is amortized over 30 years. You can have amortizations 5, 15 years, now 40 and 50 years. But the reverse mortgage, it's an open-ended amortization. So they literally can stay there to their 150th birthday because they had to pick someday. But, we already have people in the community making it to 100, and you wouldn't want to kick out, great grandma because she did 100, right? Or call the loan. And so that's what Reagan's administration really put into place back in '88, was the ability for them to live in the house for the rest of their life. And it doesn't matter the equity position. So A, they're not forced to make a payment like you were talking about. And B, they're not forced out of their house. They can stay in the house for the rest of their life. As long as they live there as their primary residence, keep the house up and pay property taxes and homeowners insurance. And if they live in an association, stay current on HOA fees as well.
Yeah. Now, what if, like, for example, somebody has their property paid off and they want to receive income? Could they do that? Like, let's say that I'm 65, I have my property paid off, and I've got monthly expenses. I can essentially receive a monthly, not income, but a monthly amount every single month to help me with those monthly expenses. And they would just take it from the equity of my property every single month, right?
That's exactly right. It just shows up as an accounting ledger on the monthly statement that they took 5,000, they took 9,000, whatever that amount is. So two situations right there in Camarillo, we were dealing with fixed income retirees that had just completed their assets because they were older and they outlived their money, but they had equity in their home. Both of those situations were exactly as you just described. They own the house free and clear. And so we had an 87-year-old in a gated community on the golf course in Camarillo, and her house is free and clear, but she only had $1,200 a month of Social Security benefits. That's what she was living off of. So she had run out of retirement income, and she tapped into about $450,000 that she could access, and she set some up monthly, automatically distributed to her account, just like her Social Security check was direct deposited. We were direct depositing $3,000 a month. And the other example I gave you was, she was doing $5,000 a month, and same situation. Both of them own the property free and clear. And the family thought that they were going to lose the home, that it was title was conveyed to the bank, and that's incorrect. It stays in their name. It stays in their trust, however they have it. And then they thought they'd lose their equity position. once their mom and grandma passed away. And it's just the opposite. All remaining equity is the heirs and beneficiaries. The estate, if it's done properly with the trust, is the best way. Otherwise, if they don't have a trust, they're going through probate court. But again, all of that money is theirs, not the bank's. And that's a big misunderstanding about the program, is people think that somehow they're going to lose out, and that's not the case.
Well, I've heard about this a lot being in the industry. I've heard that if and it's a misconception, it's just misinformation that people think that once the family member passes away that they lose their interest in the property, but instead it just depends on how long after they got the reverse mortgage they lived and what the balance is and what the fair market value for the property is. So essentially what I've done with clients is if they have a reverse mortgage, it's finding out how much they owe at the time of death, if that's the time that they're selling the property, and how much the property is worth. And just like a normal transaction, that's how much equity you have. So you can sell the property in that situation.
Yeah, and death isn't always the case. Some people decide to finally move into assisted living or a skilled nursing facility. Although more and more people are rather preferring to age in place in their own home and having those registered nurses, if they need skilled nursing, come to their home and provide care. So that's what we had in Camarillo, where she was $5,000 upside. Every single month she had $5,000 in cost for her caretakers, and so that's why she was doing the reverse mortgage, was to stay in her own home. But yeah, most people just don't understand. The reverse mortgage is just a loan that needs to be paid back in the future, and it gives them the flexibility of not having to make monthly payments. They can receive money instead of, on a normal mortgage, making a payment each and every month. If they want to make a payment with the reverse, they still can do that as well. So we've got people in multiple situations where some own the house free and clear, some have a small lien or line of credit on the property, and some people have a huge loan that they're encumbered, and the reverse can work in all of those situations.
Yeah, and it's great because I talk to a lot of people once they get to a certain age, they're on a fixed income, so sometimes they may think that they don't qualify for a refinance or because they don't make enough money. So in that case, someone like you can definitely help them.
And it's not just the needs-based clients that are fixed income retirees. We're working with a professional he's a medical professional in the Malibu area, and he's trying to retire. And his monthly mortgage is, triple of what most people's, quadruples. It's about $15,000 a month for his mortgage, but his property is worth in excess of $4 million. But as he's trying to scale back and possibly consider retirement, this is one of the better solutions for him, that he can be able to continue to live in the property, not make a mortgage payment. That changes his cash flow $15,000, right, each and every month. And so we see the reverse mortgage being used for a lot of things, but more and more people are now selling the home that they've been in for 20, 30, 40, 50 years and finding a more desirable house that they can age in place. And that's where the transaction with you and Rick, where we had that client move, that's what she was looking for. And the transaction yesterday in the San Fernando Valley, they're looking to move out here so that they can retire in Ventura. She's still working, he's disabled, and he's no longer working. So everyone's situation is a little bit different. I don't know if a reverse mortgage is a good fit or a great fit until we meet with them, sit down, similar to what you do when you're trying to find out about their real estate needs and trying to figure out where they'd like to live. Are they trying to move close to family or friends? And then what they can afford. We're going to do the same thing with you and your clients and all the people that you know. This is just an option that most people have not taken a look at and see how it works with their retirement planning, because home equity is usually the biggest asset or one of the biggest assets in a retirement portfolio, but typically financial advisors had never used it as an integral part of retirement planning, and now it can be.
Yeah, absolutely. And I think it's good because what you said is in every situation, it's different, you know? So you wouldn't know whether this would benefit you unless you actually take the time and just find out what your options are. So if somebody's considering downsizing, if somebody's considering maybe relocating to a different area, if somebody would like additional income, if somebody is in any of these situations, what would probably be appropriate for them is to sit down with somebody like you, take a look at what their options are. And then that doesn't mean that they have to do anything. All they have to know is have the information, talk it over with their family, and then decide whether this is something that they like to proceed with.
That's right. Yeah, I think most professionals will do a free consultation. I know our office does. I meet people in their home, at my office, neutral third-party locations, and we try to figure out if the family is going to be involved or other advisors. We had someone, she moved from North Oxnard to Camarillo because her daughter lives in Camarillo and she babysits her grandkids, and she wanted to be close enough so that they could come straight home or she could pick them up from school. And again, she didn't know about the transaction, and that was just for her family situation. She wanted to be closer to family. And although North Oxnard to Camarillo is only a 15-minute, 10-minute drive, depends on traffic. I guess it could be 30 minutes sometimes. But for her, that was what she wanted, was to be closer to her family and especially her grandchildren. And the reverse purchase allowed her to be able to buy the house and move up in value because her house in Oxnard wasn't as high of a price as the Camarillo location.
And let me ask you another question. What would is there a rule of thumb on about how much equity they would have to have? Because I would imagine that it probably wouldn't be someone with like $50,000 worth of equity in their property, right? I would imagine that there's probably a rule of thumb about how much equity they have to have. I would imagine that varies based on the age as well too.
That's right.
How do lenders calculate that? And this is almost from my personal knowledge.
Yeah. Unlike traditional loans where we have rules of thumb of an 80% loan to value ratio and all these, percentages, the reverse mortgage is age specific. So you hit it right on the head. Someone in their 60s is going to need more of an equity position than someone older than them 65, 70, 75 through 90. So we don't have a direct percentage. It goes into an algorithm. So it's just a financial calculator. They look at the age of the borrower or of the borrowers if there's more than one. And they look at the youngest one for longevity because, remember, they can live, like you said, 30 years in the property, 40 years in the property. So they're looking at life expectancy as what percentage. Good rule of thumb for most things is if someone has 50% equity in their home, then we're probably pretty safe without even knowing their ages. We actually want to take a look at their date of birth because every 6 months the government gives them a different factor, which increases, their percentage. But yeah, there's no good rule of thumb anymore on that because everybody's scenario is different based off of their unique date of births.
And then the cool thing about it is that it doesn't matter how, like if the marketplace drops or anything like that, So that's the cool thing about the reverse mortgage as well, too. Like if somebody did this right now when prices are high, the marketplace crashes tomorrow, they've already got that locked in already. And it doesn't matter if the marketplace drops. Like, for example, like what happened in 2008, 2009, when the marketplace, like if somebody would have done the reverse mortgage at that time, like it didn't matter if the property dropped to 50%, 40%. 30%, whatever it drops to, they're pretty much in a good position where they're pretty safe in that.
Yeah, that's some of the questions we receive. Should I do a reverse mortgage now, or should I do it when I'm older, when I'll get a larger percentage, hypothetically? And we don't know what's going to happen to the real estate market or whether the government changes the program. If you're in the program, it's fixed, it's locked in, they can't make any changes. If you haven't done the reverse mortgage, then you're subject to changes like we just had in October, and they took away about 10% for the different ages. And now people who were waiting to get more money are actually going to get less money. So again, once you lock it in, you're good to go. If you don't need all that money and it's sitting there, there's three different ways that you can take the money. You can take it in monthly checks, right? You can have it set up for life. It's called 10-year payments. You can have term, like term life insurance for a desired number of months or years. And you can have a line of credit, and you can have actually a combination of those as well as a lump sum. So we have some people like the Camarillo situation where she took $5,000 a month. She took some money up front. She set up direct deposit, and we have a line of credit for her so she can access that money. Any money in the line of credit is growing at about 5.77% right now. So we can't get 1% at the bank, and yet this money is compounding, and how much she can borrow will grow over time by roughly 6%. So if we have some people that are looking at it for maybe they didn't get long-term care insurance and they want to make sure that they have some money in case they need it in the future, set it up like a traditional line of credit, but it's the line of credit through the reverse mortgage, and now they can have that compound and grow. They can use it when they need it. They're only charged on what they're using, but that remaining portion of the line of credit is going to actually grow. And that's big time different compared to a traditional line of credit at a credit union or a bank. They'll usually give you a line of credit up to $100,000, up to $250,000, and it doesn't grow. But those, you got to make payments, and they're usually a draw period of 5 to 15 years before you have to start paying it back. And that's where we see these big balloon payments, especially with fixed income retirees that can no longer afford it. And again, the reverse mortgage doesn't have that payment.
So why does it grow? Like in comparison to like something like a equity line of credit, like why?
From what they've determined, when you're doing it now, it's based off of your age. Since you would have a larger amount as an older individual, it gives you more access to that money. You're entitled to take the money. They'll allow you to take up to 60% that first year. They don't want everybody to use all of the money that first year. So with the line of credit, you can have 60% or your mortgage payment and plus 10%. So if you have mandatory obligations, liens that need to be paid off, you can do an additional 10% above whatever that number is. But it's not considered interest on it because interest is taxable and this is all tax-free. So they call it a growth factor. It just enables that homeowner or homeowners to be able to tap into more money without having to do a refinance. Because some of our families, because of home appreciation and they're older, maybe every 2, 3, 5 years, they tap into more money. But this is designed so you don't have to do that. It's already built into the program.
Yeah, great. All right, sounds good. I've learned a lot from this. I hope that the community has learned a lot from it as well, too. Do you have anything else that you'd like to add?
Just make sure they're working with a reverse mortgage professional. There's a lot of lenders starting to do this because the refinance market's slowing up, and they may just not be as familiar, especially when you're talking with a purchase transaction and you might have listing agents, buyer's agents, multiple properties, contingencies, and a close of escrow date. You don't want to jeopardize anything. About 70% of Americans see the TV commercials, respond by calling into a call center, and now you're dealing with someone over the phone or through email. And our older clients just prefer that old-fashioned face-to-face approach. I still meet with my clients that way. Again, we'll meet in their home, our office, your office, whatever location. But that's a big difference from someone that's in a call center taking 50 calls a day or making calls and trying to follow up with someone that way. And then, we're seeing more integration now for professionals working together. Real estate professionals, title. I just came from a divorce transition professionals meeting this morning because gray law and now gray divorce is becoming more and more common. And this is a way of being able to look at the assets and how to maybe save the home for one of the two spouses in the event that they're going to dissolve their marriage.
Which I think is a great opportunity. Oh, and you've been doing reverse mortgages for how long?
Since 2007, I received my real estate salesperson license in 03. I got my broker's license in 07, started my own company, worked for Wells Fargo for years. I was their sales supervisor for reverse mortgage for the area, and dedicated since 2007 to just doing reverse mortgages. I don't do the traditional loans anymore. I just try to specialize on this one area. I really feel I'm on mission to educate and inform as many people, because most people don't know about the program like you and I just talked about.
Yeah, perfect. Well, I think it's been extremely valuable. This is the Jose Luis Morales Show. This is episode number 8. I want to thank you, Carlos, for coming on the show and for allowing the community to learn a little bit more and to make better educated real estate decisions. So thank you for that.
You're welcome. Anytime. Thanks, Jose Luis.
Likewise.